Good morning, everyone. Welcome to Phillip Securities Research Morning Call for 11th of December 2023. For today's stock counter updates, we have BRC Asia, Cromwell European REIT, and FUU, and we have quite a few macro and sector outlook updates and technical analysis from Zain. So do note that this would be our last session for 2023, and we would resume on January 8th, 2024. So let's begin with FAANGM monthly for November. We had released a report this morning with the title Lower Treasury Yields Pushing FAANGM Higher. So overall for the month of November, FAANGM stocks, they were up about 10%, and this was the third best month year to date for 2023. Whereas in November, S&P was up about 9% and Nasdaq was up about 11%. So we believe that the main gains, this was mainly because of the lower treasury yields and market expectations of faster rate cuts. In terms of individual stocks, Netflix was the biggest gainer. It was up about 15%. And this was mainly because the positive earnings momentum continued, and also there were healthy ad-supported user trends. Whereas Google was the laggard, it was up just about 6.8%. And we believe that the stock consolidated mainly because it's losing its cloud market share. Whereas, despite this strong gains in November, we believe that FAANGM valuations are still attractive, mainly because it's still the forward PE multiple. It's still trading below its 10-year moving average of about 32 times. So let us now begin with the major news for each of the individual stocks. So for Meta, there was not any major significant news. However, in November, the digital ad spending trends, they rebounded after a last couple of months of softness, mainly because the advertisers, they look to cash in for the Black Friday and Cyber Monday sales. And if the trend continues into December, if it sustains, then we might see a better than expected earnings for the fourth quarter of 2023. Moving on to Alphabet, it's losing some market share towards ChatGPT. So Google, it basically lost 0.8% market share year over year since ChatGPT was launched, and the web traffic also month on month basis it was down by about 0.4%, and we believe that this was mainly because users they moved towards the large language models like ChatGPT. And despite this market share, Google, it still holds a dominating position, and it has a market share of about 91.6%. So moving on to Netflix, the actor strike, came to an end in November. So what happened was that major studios and actors in the US, came to they signed new agreement, and under the new contract terms, the actors, they would receive about 1 billion, over 1 billion of compensation and higher bonuses from the top performing streaming shows. And Netflix, secondly, Netflix, it also reported ad-supported users of about 15 million. So basically, last year in November, Netflix, it had introduced the ad-supported tier plan. So within a year, it reported a significant growth, like about 15 million users for this particular plan, and it represents about 6% of its total user base. So the growth has been significant, and we expect that it should continue, mainly because it's attractive pricing for the users, and also it's margin attractive for the company. And the company, it has been significantly improving the experience and for both users and for advertisers. So moving on to Apple, there has been the demand for its new iPhone 15. It has been slowing down. There are data points like the inventory levels right now for iPhone 15, they are significantly higher as compared to the inventory levels for iPhone 14 last year. And company Apple, it has also been boosting its trade-in prices for old devices and also for Android devices in order to encourage users to switch or upgrade to their new iPhones. And secondly, the Apple, it will be the Amcor Technologies' first and largest customer. Introduced a 2 billion manufacturing and packaging facility in Arizona, And the Amcor, it will also package Apple silicon produced, which is produced in the nearby TSMC fabrication. And moving on to Amazon, for Amazon, it's expected to be the largest number of deliveries for Amazon. It has expected to reach that higher than its competitors like UPS and FedEx. So for 2023, for Amazon, the number of deliveries are expected to reach about 5.9 billion, whereas for UPS, it's currently about 3.4 billion, expected to be about 5 billion. And FedEx, it's behind UPS. And secondly, Amazon, it's also in November, it introduced that it has signed it plans to launch online vehicle sales on its platform, and it has partnered with Hyundai for that. And so basically the users, they would buy the vehicles on Amazon's platform, and they would pick up the delivery from their local delivery partners, dealer partners. And since Amazon, the e-commerce has been resilient, and it's expanding into the new domains, we are positive on Amazon. So moving on to the last stock counter, Microsoft, it announced a quarterly dividend payout of about 75 cents, and this would be payable on March 14th. And the ex-dividend date would be February 14th. So if you buy the shares on February 14 or after that, you might not be eligible to receive the dividend payouts. And secondly, Microsoft, it mentioned that it's currently manufacturing its own custom silicon chips, and they could introduce them in the market as soon as 2024. So basically, the two chips, first one is the Maya 100 chip, and it's basically an AI accelerator chip, which is particularly aimed to to train and inference the AI related workloads. And the company said that currently its Office 365 AI product is under testing for this chip. And the second chip is its Cobalt chip, which is basically like aimed to speed up the general purpose computing tasks. Like it's currently testing its a Teams platform right now. And however, the company, it highlighted that they would not commercially sell these two chips, and they would just currently they plan to integrate these two chips into their existing data centers, and thereby reducing the reliance on the chips for NVIDIA, and it might also be cost effective for Microsoft. So to conclude for FAANGM, overall we remain overweight, and mainly because of the lower treasury yields, and valuations are still attractive, and with the recovery in digital advertising and e-commerce being resilient, we are overweight on FAANGM. However, in the near term, we do expect some headwinds, like weak demand for iPhones and PCs. So that's all for FAANGM. I would now like to pass on to Darren for Cromwell.
Yeah, thanks, Ambrish. Yeah, so we hosted Cromwell for Corporate Insights webinar last week. So these are just some quick highlights in case you missed the webinar. So Cromwell is a 750 million euro market cap, pan-European commercial industrial logistics REIT. So currently it's about 50% of their assets in light industrial or logistics assets. And if you look at the chart on the left, they have a target to hit about 60% in light industrial and logistics assets and 40% in grade A office. So currently they have some grade B and C offices that they would like to divest, and they also have some redevelopment plans for these office assets to make them grade A and green certified. And they also have some logistics assets that are under development that will help to bring their portfolio to about 60% like industrial logistics assets. So for the third quarter business update, their distributable income was up 3% quarter-on-quarter, but it's down 7% year-on-year, mainly due to higher finance costs. And for their capital management, their all-in debt cost is about 3%. The ICR is still healthy at 4%, and their net gearing post the divestments that they did is 37.4%, and they have 91% of their debt on hedge and fixed rate. So their next step expiry is the 500 million bonds that expires or rather is due 2025. So that's about 2 years time. Their portfolio occupancy for the quarter was at 95.2%. It's rather resilient, rather stable. It's dipped slightly quarter on quarter, but the rental reversions still are pretty strong for this quarter. But the rental reversions was strong mainly due to the high rental reversions from the office sector. So their office occupancy, it improved to 89.1%. It's up 140 basis points quarter on quarter, and they had very strong rental reversions for the quarter, 19.9%. So this is probably shows that their office portfolio is probably under rented, and there's some demand there. And we note that there is a continuous flight to quality for the office sector, where grade B and C offices are most likely really obsolete, and most occupiers, they only want a high quality, best in class space and grade A offices. So a lot of occupiers are willing to take up less space, but they are willing to pay higher for the rents for the amount of space that they're taking. And they also noted that work from home ethic, as more companies require or rather mandate employees to come back to office. So for the light industrial and logistics, it's 97.1% occupied, and for the quarter they had a slight positive rental reversions of 2.7%. And the management noted that the demand is coming from reshoring and nearshoring. So the good thing about Cromwell is that their portfolio is indexed to CPI or inflation. So the majority of their leases are tagged to this CPI annual indexation, and some of it is a full 100% of the CPI will increase, the rent will increase by the 100% of the CPI, but some of it is a portion, maybe perhaps a 75% or such. So it differs between the countries, but basically they have their leases are tagged to CPI. And Cromwell, they also have a divestment strategy to keep gearing within the healthy limits of about 35 to 40%. So they've in FY22, they've since FY22 they've already divested about 229 million euros, and they managed to divest it at a premium of 13.7%, which shows that their assets are good and the buyers are willing to pay more for solid assets. And they still have another 200 million euros of divestments in the pipeline over the next 2 years. And this will help to keep their, assuming they use these divestment proceeds to pay off debt, and they will keep the gearing within the 35 to 40%. And for now, for the outlook, we expect that the cost of debt to remain at about 3%, or rather peak at around 3%, as we know the global markets, the interest rates are already peaking or have already peaked. So we expect the interest rate to stay, maybe increase only slightly from here. And their strategy going forward would be to keep a hold on acquisitions, and they would rather redirect the funds into redevelopments with higher returns potential or paying off their debts. And management also noted that the growth in e-commerce logistics space take-up since pandemic has slowed, especially since during the pandemic era, the growth in e-commerce logistics space, it was very high. So it slowed from pandemic highs, but we still expect it to rise over the next few years going forward for this e-commerce logistics space. And Cromwell right now is trading at an attractive dividend yield of about 12%, and they're trading at over 40% discount to book value. Yeah, so that's all for me from Cromwell. I'll hand over to Zane for technical analysis. Thanks.
Thanks, Darren. I'll move on to the technicals. Yeah, for S&P 500, we continue to trade in this current uptrend channel as shown in the chart. Then we also set a new year high closing level on Friday as well. So with that, potentially we could still see the bullish momentum continue to see a potential retest of the highs we saw in March last year, and that was at the 4,640 level. So for S&P 500, the current resistance is likely to be between 4,600 to about 4,640, while the immediate support is likely to be between 4,520 to about 4,570 area. Next slide. For individual counters, we have a technical sell for ST Engineering at 368 with take profit level at 346 and 333, stop loss at 378, stop loss closed at 377 on Friday. So for this trade, actually hit our stop loss, and the trade was validated. So the original trade idea was that the price has been finding resistance along this short-term downtrend resistance line shown in the chart, and there was a potential breakdown of the main uptrend channel, coupled with bearish momentum on both the MACD and RSI. Next slide. So this is just a summary of the trade initiated, and the stop loss was triggered with a drawdown of about 2.7%. Okay, that's all from me now. I'll pass on my time to Peggy to talk about BRC Asia results. Thanks.
Thank you, Zain. Morning. BRC released the results in November. Last Monday, they had a briefing for analysts. Okay, we are maintaining a buy call for BRC at a target price unchanged at $1.99. Just briefly run through the results. The earnings were 14.8% above what we expected. The reason for the variance is the 24 million write-back in provisions for onerous contracts. This is also offset by a 8 million valuation cut at the Maldives Hotel and a 6 million doubtful debt provisions. Net profit for the whole year was down 16%, mainly because of a 20% year-on-year decline in the average selling price of steel rebars and a lower volume in first half 23, when there was high increased safety measures being imposed on work sites that affected the ability of the customers to take deliveries of the bars, the steel bars that they have ordered. So, but second half, revenue and net profits has rebounded from a very weak first half, and second half numbers were actually levered the performance in second half of the previous year. So we expect the second half, we estimate that ASP actually fell by a larger than 7% in second half of 23. So which implies they had a very strong volume recovery. So that's a good sign. The second point is that gross margin had eased slightly, mainly because they had a bigger share of trading activities. Trading accounts for about 1/4 of the revenue in FY23, and trading is typically lower margin. But with the manufacturing and fabrication volume to rise in FY24, we expect gross margin to go back to edge nearer back to the 9% level. Demand remains very strong. It's underpinned by the still current order book of 1.3 billion sitting in their backlog. Then the net gearing has improved from 0.76 times last year, then fell to below 0.5 times in FY23, mainly because of the reduction in working capital requirements. And net debt to EBITDA is fallen to 1.5 times versus 2.3 times previously. Okay, the next slide, please. Okay, thanks. So we come up, we had raised our FY24 forecast by 5.6% to take into account the lower interest expense as with an improved debt level. And we also introduced our FY25 earnings. We believe steel prices have bottomed and will remain stable for the whole of 24. And construction demand is expected to accelerate from here, led mainly by the private sector projects, such as public housing. The government land sales is also announced a new record in first half of 24. And infrastructure projects such as T5 has begun to roll out. So for BRC, the order book comprises mainly public sector jobs. That has lower risk of default and delay. So give us a greater assurance that our numbers can be met. Our DCF derived target price is $1.99, which is unchanged. Thank you. Next slide, please. Fuyu Corporation with Phillip on the ground. They had an analyst briefing last Wednesday, analyst and investors briefing to provide an update of the company. Just to recap, Fuyu still is a plastic precision tool and parts producer and sub-assembler. They run 6 plants now, 1 in Singapore, 2 in Malaysia, and 3 in China. The market cap is about 100 million. In January 2021, there was a change in management and shareholders. Pilgrim Partners acquired slightly less than 30% stake from the existing founder, so there was no GO required. And then David Xiao was appointed as an executive director, and he was lately redesignated to become a CEO in September 22. And with David Xiao on board too, they added a supply chain management business. In simple terms, it's just a commodity trading. At that time, they had a balance sheet of about 100 million. In the balance sheet, they had 100 million cash. So that's very useful for a commodity trading operation. Net cash at the end of June this year had fallen to 55 million. The company introduced 5 new corporate strategies. One is to construct a smart factory at 9 Tuas Drive. The factory so far has cost them 22 million capex. They expect to incur more to get it out by second half of this year. And the new factory will be able to handle high precision, such as 2 to 5 micron. And they had also secured medical and consumable projects for US, Europe, and Asian customers, which they refuse to give any names. And they target electric vehicles and biomedical sector. And the second strategy is to enlarge their market presence, in particular in the biomedical sector. They will also begin a clean room construction at this Tuas plant in the first half 2024 for biomedical work. They are accelerating sustainability. They also embark on product design, engaging with the customers early at the design stage to raise the customer stickiness. And the last strategy is to raise the investor profile and pursue M&A. So for the outlook, the management expects higher revenue in 24 compared to 23. 23 is not ended yet. So far, first half 23, the revenue was 71 million, a decline from the previous year. This can tell from the table on the right. And it also says that gross margin for FY24 will exceed that in first half 23 of 9%. With biomedical contribution. Okay, so for first half this year, they actually slipped into a loss of net of 4 million. And NAV it was at 18.6 cents at the end of June. Thank you. Let me move on to equity strategy for this week. Okay. Last week, some of the it was a week of very heavy macro data, but I just list some of the key ones for the US and China market. In US, of course, the first Friday we had the November non-farm payroll data, which confirms a slowdown in the economy. About 999,000 jobs were added, but that also include those that have gone on strike, the auto workers that has come back to work, and the screen actors that went on strike in August that's also returned. And across the data can tell there's a widespread slowing in the private sector in terms of new hires. Construction jobs were the one that pick up the slack. The average hourly rates up 0.35%, which is in line and actually pointing to a softening tone going forward. So this data and given that the state government actually had a decline in budget of about 10% going forward. So we think these government jobs that will be challenging for government jobs to continue to grow at this level. So with that, FOMC's coming Wednesday meeting is likely to announce a rate pause, and S&P 500 last Friday closed at a high, the year's high. And in China, we had the November trade data. Exports expanded for the first time since April this year. It's up 0.5% year on year. Imports, however, fell after an increase in 3.3% in October. It fell 0.6%. It's dragged down also by crude oil imports. When crude oil imports fell for the first time since April, it reflects both a high oil inventory and more slowing domestic economy. Among the data, as we go further deeper, we find that mobile phone exports actually rose 54%. Because this was a low base last year, but shipment volume also rose. Right? The other IT exports were also positive, in the positive territory. IT components imports returned to positive growth after 19 months of contraction. Points that led us to think that to have a stronger conviction that the upswing in the tech cycle is coming back. So it will benefit all those companies in the supply chain, those countries in the supply chain as well, including Taiwan, Vietnam, and Singapore, and maybe Malaysia. In Singapore, we had softening of retail sales in October, down 0.1%, the first decline since January this year. The segments that decline were more like the discretionary, the big ticket items, recreational goods, the sales at department stores, furniture and household. Food and alcohol continues to stay strong. It's up 22%. Lead us to think also that the CPI inflation numbers for the remaining of this year will stay high and will likely meet MAS core inflation target of 4% for the whole year. Okay, next slide, please. So just to follow up on last week's tactical view, we pointed out that the lower interest rates is a reprieve for the ASEAN markets, as the central banks are now need not have to rush to have don't have the urgency to raise rates to address the decline in the regional currencies. And the lower interest rates is good for tech, for REIT, and potentially we also like China markets. And another sector that worth mentioning is property developers. The one data point that came out last week was the government land sales announced. The government announced government land sales for first half of 24. They will add another 5,450 private homes. Another increase, another high since second half of 2013. An increase over second half of last year. In this side, in the second half of last year, the second half of this year, so 23 is still not over. Yeah. The second half of 23, the government introduced, the URA introduced two new concept called long stay service apartments with 3-month minimum stay requirement. The 535 units were introduced in second half 23, and first half 24 GLS, there's another 515 units for one plot of land at One North. This is to address rental demand. For this plot, there will be no strata sale allowed, which means the developer, whoever wants to bid for this piece of land will have to pay for the whole, will have to invest incur a very high investment cost to build it up, and you cannot subsell it for other holders who wants to do to let it out for rental purposes. So we think there will be a limited pool of buyers for this. There will mainly be hotel and service apartment operators. The move probably as well to address the rental demand as speculative purchases have or purchases for investment purposes have declined after the increase in ABSD in April this year. And a lot of the latest property transactions are mostly owner occupied, right? So, but still with more BTO being rolled out in 2024, and with all these aggressive GLS launches, we expect property transactions to pick up next year, which is good for the agencies. It also means more options for the developers. And the fixed mortgage rate is now competitively priced at 3%, well below the SORA which is another probably another point that will encourage new buyers. So therefore, we think the property developers might be worth a look now that they are trading at a very steep discount to the RNB. For the events next week, this week, we have a FOMC meeting on Wednesday, and BOJ also have the quarterly Tankan discussion. Then on the 18-19, BOJ will have a policy meeting, which the market is speculating that they will raise rates, which we think differently. For corporate insights, we have the Marco Polo to round up for on the 12th December for the year for us. Please, if you are free, dial in to listen to them directly. Okay, that's all for me for today. I'll hand over to Paul for some interesting stuff this is going to share. Thank you.
Yeah, thanks, Peggy. So this was a presentation we did 3 weeks ago for another event, but since it's year end, so we just do this now. Do note that most of the recommendations, just take it with a pinch of salt. These are just trading ideas and not like hard report kind of recommendations. Next slide. Okay, so in terms of some of the risks, so this presentation is just about some of the it's a roadmap of what are the kind of the risks. Although some of these are really long tail risks, so I wouldn't say that these are high probability events. But the first thing would be the election cycle happening in 2024. So we first have the Taiwan elections to start the year. Next slide. So the elections is going to be held on 13th of January. I think 4 years ago, nobody really bothered about Taiwan elections, at least if you're a Singapore investor. But I think these days with the geopolitics, I think we're paying more attention. So there were 4, but now there are 3 candidates. I'm assuming most are familiar. So we have the ruling DPP, then we have the Kuomintang and Taiwan People's Party. Most of the candidates basically have a status quo commentary, but of course the biggest risk is always DPP. Taiwan has a so-called small I independence, but the key thing, the so-called red line, is whether they will announce that real independence is away from China. For us, we don't think that is the risk, because I think they also be mentioned that that's the status quo, and obviously we can only assume that they will know what's the repercussions if they do that. The big I independence. Next slide. So just to give a backdrop, I think crisis in Taiwan Straits is not new. This already happened 3 times before. The most recent was when Nancy Pelosi visited Taiwan in, I think it was September, in 2022 or November. Then what happened was that there was a lot of live military drills on the right, so that also caused a lot of worry for the markets. You can see on the right here, it doesn't mean that China doesn't know where Taiwan is, but it's just a way to, just one of the military drills just to show their displeasure. Of course, the worry now is, will we have the 4th crisis? I think we all know what's the worst case scenario. Even events like in Ukraine does have some repercussions. I guess if the US is not funding Ukraine, one can take it as a read that it should also worry observers in Taiwan that know whether how supportive will the US be, especially if you have Trump coming in, which is more America first. The other issue is that the US policy has always been strategic ambiguity, which basically means not very clear until the worst case scenario happens. Next slide. So what to do? I mean, the worst case scenario, most important, they don't cross the red line, which we don't think so. Even the US comments from the US defense is that the capability, not intent, the capability of China, this is quoted by them, by one of the generals, is that the capability of China to take on, or at least have some conflict, if there is any, the military capability will probably only happen in 2027. Again, this is not intent, this is just their capability. It's probably only by 2027. And even if there is such a conflict, we probably could get some heads up. There'll be some national mobilization, stockpiling, repatriation of assets. Hopefully all this never happens, but again, this is just some scenarios. So what's the trade? Now again, take this with a pinch of salt. Of course, you were long treasuries because you were in the high risk mode, and then of course gold. But we also think that any cause of concern is probably an opportunity to buy. Is probably more headline risk than anything if the DPP were to win. So we don't think the worst case scenario is a high probability event, hopefully. The other thing is that, of course, just you can, of course, stockpile canned food. That's probably because we've always been asked what happens if there's a worst case scenario of a world war. Then I think canned food is probably the one, because canned food can last for 5 years. Again, just take it with a pinch of salt. This is not a serious presentation. Or you can long Sheng Siong because everyone will be stocking up. You can also long Latin America because it's going to be the furthest countries from the conflict zone. Next slide. Of course, the other thing to watch is actually a more bigger problem is actually this island called Senkaku. Every country has their own, even Taiwan has claims to it. Everyone has their own name. The worry for this so-called island, which is only probably a bunch of rocks of 7 kilometers, is mainly because the US has a defense treaty to protect this particular bunch of rocks. I'm not sure what's the history behind it, but so actually in November, Biden also said that there's a security guarantee, and it's a clear commitment that they have to defend this bunch of islands. So if there's any incursion, then by default, because of the defense, to defend it, and of course the US has 54,000 military personnel in Japan to respond to it. So whereas in Taiwan is strategic ambiguity, but this bunch of islands is actually a commitment. What's the trade? I know you can trade anything you want. Is probably defense sector, buy some Navy vessels, because it's going to be a lot of heavy fighting using the Navy. Next slide. Of course, the other one is US elections. All these are the probabilities, but all this change and it's still far away. There's also court cases and so forth. But again, just for discussion purposes, the elections is on 5th November. Of course, there'll be more volatility, and it will become a more America first policy, more protectionist, and probably more pushback on climate change. I mean, these are just some possibilities. Of course, you can short Elon Musk since he doesn't like X. You could also short media stocks, short Netflix, because everybody will be watching news rather than watching entertainment on TV. Of course, you can long VIX because volatility will increase. You can short renewables. And long equities and inflation because you probably do a lot of spending. Again, these are also kind of traits that we think. Yeah. Next slide. The other one is Indonesian elections. I don't think there's really much of a next slide. Much of a risk for Singapore investors. I think most are very poor investments and so forth. But because it's the largest country nearest our largest neighbor, so it's just something to monitor. It's probably most of the policies are actually continuation. Probably only Anis is a bit more of a pro-worker policy. Just as a bit of backdrop, in Indonesia, there will be a runoff. That means if there's no party that wins more than 50%, then or 20% of some regional authority, then they will have to do a second round of elections, which only 2 candidates. And so, I mean, based on paper, most likely it will be Subianto will be the winner. I mean, based on the polls right now. But there's usually a runoff. So the third candidate will come off, and there'll be 2 candidates will be just competing with each other. But again, I think most important is that there's continuity, and it will be more positive for Indonesia and for the whole region, including Singapore. Next slide. The next is just monetary policy risk. Yield curve on control. I'm referring here to China next. To Japan. You're right. It will be Indonesian elections, because after these elections, then it's I guess presidential elections. Okay. The next one is just on Japan that's trying to control its interest rates. The numbers here on the right is just some of the events for those who don't really follow. So Bank of Japan started this so-called yield curve control, or keeping interest rates at 0. So this is their 10-year. They keep it within a range of -1 to -0.1, -0.1 to +0.1. It started to have more reaction only in the last few years. So March, it started to raise the band, then again raise the band again. Then in July, which really shook the market a bit, is that they're willing to let the rates rise up to 1%. Then in October, they said that the 1% 10-year bond yield was just a reference. So it actually removed the cap. And recently, they also hint of negative interest rates. That because in Japan right now, if the commercial banks put money with Bank of Japan, is a minus 0.1% interest rate. So that's why we call it probably the last country we have a negative monetary policy. You can see the challenge that the Bank of Japan has. So this is the 10-year bond yields, which you tend to be above inflation, no, pre-2016, I guess. But you can see the inflation is running far ahead, and they've not actually risen the interest rates. So that's the challenge they have. But for them, they still think inflation. There's no real clear sign that inflation is going to be meeting their targets. I mean, that's their viewpoint. So they have a lot of pressure to stem down interest rate inflation, and that's why they're slowly creeping up interest rates. Next slide. So so what is the risk now? So there's two scenarios. So one scenario is that they actually raise rates aggressively, but if you raise that, then you risk of this doom loop. Because why we say doom loop is that their fiscal deficit could blow up even more. Right now their deficit is about 6%, and this is at virtually zero interest rate kind of environment. But if interest rates really skyrocket, then they run the risk of fiscal deficit climbing higher, then the deficit will climb higher, then they have to raise more money, then interest rates will climb, then you got this so-called vicious spiral downwards. That's one scenario. Next slide. But the second scenario is that they don't raise rates, and then you have this very weak Japanese yen. And the other worry is that if you raise too aggressive, so you repatriate money. But again, these are very extreme scenarios, but most likely is what they're going to do now. They will just slowly creep up interest rates, and this will at least be a bit more stable. But the worst rate is that if you raise rates aggressively, sorry, a bit confusing here. If you raise rate very aggressively, then you have to then the first scenario is what we mentioned earlier, whereby then you have this doom loop of interest rates, then interest rates continue to climb, then there's all this talk about, which we don't think is likely, but there's a huge repatriation of Japanese assets back into Japan. You can see here, what is the assets they have? They have about 4 trillion. 4 trillion of assets overseas, portfolio money assets. 2.2 is debt and almost 2 billion of equity. So we don't think they're losing control, but again, we're just running through all kinds of scenarios. We're looking for risk here. So what is the trade here? We think it's probably less long Japan bonds, because we think they're probably going to keep rates continue to be low, or actually long Japanese banks is probably the one, because if they remove negative interest rates, then they will help the Japanese banks. But again, these are all just our trade ideas. Next slide. Of course, what is happening now in Japan is that they are continuing to support the Japanese yen with interventions. But this can be disastrous through, I mean, this is just as a case study. So in 1976, the UK actually had to do an IMF bailout. That means they ran out of US dollar, and what they did was when they cut the rates, the British pound went to below $2. Then they continued to try to support their currency. So you can see here in 1976, their reserves actually collapsed. Don't look at the 77 because that looks a bit high. But in 1976, they had about maybe 8 billion of reserves. Then they used almost all of it, or 20% on one day on 8 March 1976 to just support the British pound. Then 29 September, they had to get a bailout because they didn't have enough foreign reserves. This is probably not likely for Japan because they still have a lot of reserves, but there's one scenario. If you try to keep on defending your currency, then you run out of reserves, then even a developed country, which is very rare the developed countries require support, not a developing. So from March to November 76, they spent probably almost 6 billion out of their 8 billion of reserves to support the currency. So that can be disastrous. Of course, this is not a scenario for Japan, but this is something that we just monitor. That's one pathway where a developed country needs IMF support. Okay, yeah, and again, these are low probability events. No, today we are playing a role of risk manager and looking at all kinds of scenarios. Next slide. The other one is higher rates forever. So next slide. This is probably more of our 2024 strategy. So what we think is that the private sector in the US, so this is the US government requiring money every 12 months. So what we thing has happened is that the private sector, because of the stimulus that the US government did, they took up all this debt. You can see here almost 4 trillion and just bail out the US household and businesses. So most of the private sector debt virtually passed on to the government. So as a result of this, you can see that every pre-pandemic, the US government every 12 months needed like 1 trillion or 1.5 trillion of financing. US Treasury means the government, US government. Right now, it's running at almost 3 trillion. And with higher interest rates, you should expect this 3 trillion to continue. So that's why we think it's going to be hard for Treasury bond yields to come down very sharply, because the amount of borrowings that the government needs is huge. It's like 1.5, now doubled to 3 trillion. Next slide. And the other thing is that they will continue to borrow more, because by 2033, almost 40% of their income tax collected will go to paying interest rate. So you have this also similar to kind of Japan scenario. If you run rates too high, you have this doom loop where you need to borrow more because interest rates more, and then because you borrow more, then your interest rates keep on rising, and then you keep having this very vicious cycle. These are the projections before the recent jump in interest rates. So this could actually be even higher. The blue line is just the amount of debt that they have to take on the US government. The next slide. The and the other thing that's happening because of geopolitics, you can see that partly also because the deficit is coming down. You can see the blue line that China is actually selling, or at least winding down a lot of their US treasuries. So geopolitics also raised the rollover risk. What we mean is that the ability for the US government to finance is also affected by geopolitics, because China will probably want to own less of the treasuries. We also see Japan winding down some of the treasuries. The only one that's buying is probably their so-called allies, which is US in Europe in green, and also UK. So this is also one factor. It's not the only factor, because China, although 1 trillion, but US has about over 32 trillion treasury market. So this is one of the factors that also could keep interest rates high, because one party is selling. Next slide. So the other thing is regulatory risk. This is more for US stocks. Next slide. So breaking up the new East India. So what we mean by East India company, East India was like a monopoly. I don't in 1600s or 1800s, but so we're referring more to the FAANGs. So obviously, in the news, you will always see the FAANGs being sued by the US government. There are many cases all over, but one of the bigger ones is the Department of Justice versus Google. So right now, the trial has been over, but there's the ruling will probably come in. There'll be a second round in May, but the ruling will come in probably in summer or the third quarter 24. So not to run through all the details, but basically they are complaining about is the Google search monopoly. So Google has a 90% monopoly in search in the US. So the problem that the Department of Justice is arguing is that Google pays about 26 billion in 2021 to Apple, Samsung, and wireless carriers. So you can all read that. They also share some of the ad revenue with Apple. So why are they doing this? Is because the Department of Justice believe that there's this thing called the power of default. So they want all users, when they turn on the phone or whatsoever, on Apple phone, by default, Google search is there. And there's a lot of power when you have a default setting. And the US government claims that Google is sharing monopoly profits with Apple in order to maintain the monopoly. And the Department of Justice wants structural relief. Structural relief means breakup. So that's the worst case. Paying money, of course, Google can do it, but the breaking up will be the biggest issue. So from Google's point of view, to them, they said those 26 billion, the billions that they pay to Apple is to help advertisers, marketing costs, innovation costs for Google. But that's what they claim. And they claim there's many other search tools and so forth. So the issue right now is whether this payment, that the billions that Google pay to Apple, is it really a legitimate purpose, or to keep their marketing power and to share monopoly profits with Apple and so forth? And whether this payment that they make actually helps the user. But the key thing is there's a remedy here. So I think as a Singapore investor, if there is a breakup in the FAANG stock, then maybe liquidity can flow back to Asia. Then, the Magnificent Seven may not be so magnificent. But again, this is you probably get a final conclusion only in first quarter 25. They will have a ruling, but they will still have a remedy only in first quarter. Again, this is just to update everyone, just to keep a watch on all these things. Of course, the thing we have here, the trades to long Microsoft because they're probably the one least affected. But if this ruling goes on, then maybe it could hit Apple. I mean, it could hit Apple, it could hit also Samsung, and could also affect them because they won't get this huge payout from Google. Next slide. Okay, this ESG. Okay, we are big fans of ESG again, but this is just topical discussion. Next slide. The new shiny object. So, okay, this chart here that you see is a ETF of the one that all of us know, the S&P 500 ETF, and you see the lines are very close to all the other ESG funds. So there's this ESGU, the black line, which is the ESG aware. Then there's this BlackRock ESG select. So our point here is that if you look, most of them, they replicate each other, and you look at the holdings, the S&P and some of these ETFs that are so-called for ESG purpose, they're almost a replica. I mean, you look at Apple, 7.2, 7.3. But the big difference is that there's probably a 50% more fees that they collect from selling these ESGU ETFs. So the big worry here is that, no, are these really real ETF for the environment that can help provide change, or just more like perception? You just buy this, but you're technically buying a S&P index. So again, so this is, but you're paying you're paying 50% more expense ratio, which is basically the management fee under this cover of ESG. Again, this is just for discussion. Next slide. The other thing for ESG is that the performance has been really poor. You'll notice the blue line is the one of the ESG funds. So I should put a description, but actually it's the wind farm. It's a pure ESG fund performance. But you can see it did very well in the pandemic. But why from the index collapsed probably by more than half? So high interest rates. In conclusion, high interest rates is the biggest enemy for ESG right now, because if you're building a wind farm or solar farm, the capex is high. You put in a lot of upfront capex, and the economics will turn big, or it's not attractive anymore when interest rates are high. So the biggest enemy for ESG is not carbon, it's probably interest rates. Of course, high equipment costs during the pandemic. Even in the recent offshore wind, there was even no bidder, which shows the poor economics of offshore wind right now. Project cancellation, supply chain. I won't go through details with that. Next slide. And of course, ESG, there are also still some unresolved issues. Most of it's measurable, but level 3 is going to be challenged because you got to measure your supply chain so far. And social is also sometimes quite unquantifiable and very subjective. And also governance, I think there have been hit and misses. Even FTX had high, I think their governance was even higher than Exxon. And also there are some gray areas. Soft drinks is considered fine. Confectionery, sugar-free products is fine, but and the other problem is that the problem that ESG face now is that the consumers are not ready to pay more. So when we speak to corporate, sometimes they can provide new equipment for ESG and so forth, but in the end, the customers doesn't want to pay more. Apart from saving utility costs, but if not, most customers are not willing to pay that extra for this so-called ESG. So that's the problem some of the corporates face. So the thing here, what's the trade now, is just to long some of these underpriced non-ESG like gaming, tobacco, because everyone's running away from it. I'm not advocating buying weapons and alcohol and so forth, but again, because they are so under-owned, everyone's pushing, tilting one side towards ESGs, and the other side that is going to be very under-owned. I mean, that's what we mean by that. Yeah. Next slide. The other one is just one last one. I think macro risk. I think this one probably everyone knows. It's just China, because everyone worries about China. Next slide. I think we talk a lot about this, but I won't run through because of property. So property is hurting the upstream building materials, local government finances, number 2, number 3, consumers, and of course banks. Even the banks' collateral are being hurt. Next slide. But I think one thing China has is not billion here, it's trillion, is that there's a lot of liquidity here. So if you look at the deposits, you're looking at 40 trillion of deposits. So there's a lot of liquidity, and the government deficit is only like 3% or so forth. So they have enough of liquidity and firepower to, I guess, kick the can down the road, in a lack of a better word. Next slide. So I think again, this is just for entertainment purposes. So some predictions can go wrong. Like this book on the left here was about China collapsing since the year 2000. The latest one, which is the Thucydides trap, whereas the one that everyone's talking right now is whether China will have a conflict with the US, because there's always, whenever there's an emerging power coming up, there tends to be conflict. Not all the time, but it tends to be conflict. So hopefully this book on the right will become like what this book on the left, which after 20 years there's still no collapse. Anyway, I mean, we're just doing this for entertainment. Next slide. So what is rainbows and unicorns? So what can help global demand? So of course, for us, we think global aggregate demand is going to be pretty weak next year. For 2024. But what can help the whole global environment? Next slide. What we need is a rebalance. So what we need is a weaker US dollar to rebalance global wealth, because for instance, let's say if there was a stronger RMB or stronger Indonesian rupiah, then the Indonesian consumer or the Chinese consumer can purchase more. So this will rebalance the wealth. So this chart basically shows that in the US, their current account, so current account means their trade and services deficit is running almost 1 trillion if you look on the left. But the US dollar continues to strengthen. So this is the kind of big imbalance happening right now. To rebalance global growth, you really need emerging markets to have stronger currency so that their consumer spending can be stronger and rebalance and improve aggregate demand. Okay, and I think that's the end of it. Again, just take it as a pinch of salt. It's only for entertainment purpose rather than hardcore recommendations. Yeah, I think we can move to our Q&A. Thanks, everyone.
Right, yeah, I think I'll answer some. The first one is any update on Prime and Manulife? Yeah, so Manulife, they came out with their restructuring plan. So I gave a presentation about it last week. It's quite a lot inside the plan. So basically the recapitalization plan is they're selling Park's Place to the sponsor, and then they get a sponsor loan, and they're also using 50 million from their cash to pay off a portion of their debt. And then they also have a disposition mandate, which it goes through about 300 over million. When it goes through, rather when the assets are sold, it will bring the gearing down to slightly under 50%. Yeah, so that's just the gist of the plan for Manulife ESG. But since last week, there's no updates, but they did have a SIS dialogue session. And I think there's a follow-up question below that says what's my thoughts on the SIS regarding Manulife. Was the manager's answers to SIS questions satisfactory to you? What market reactions would there be if EGM vote yes or no against the 3 resolutions? Yeah, so this is a follow-up to the earlier question. So the resolutions are all interconnected. So all 3 have to be a yes. So basically, the best case, in our opinion, would be for all of the resolutions to pass. So basically, all yes, all go through, so that Manulife can begin this recapitalization plan. And in the situation where any one of these is no and does not pass a 50%, so the threshold is 50%, then Manulife might probably have to, because all their loans will be straight away, the lenders can straight away recall all the loans as is all current if the resolutions do not pass, and then which basically means they are in a breach situation. Because if the resolutions pass, then there'll be a waiver of the breach, but if it does not pass, then they'll still be in a breach situation and the lenders can recall all the loans, and as a result, there might be a possible liquidation of the Manulife assets, and yeah, that's not the situation that we want to be in. So sorry, the question ran. So yeah, so our house view is that you should vote yes. So that's the first thing. And then what market reaction would there be? So first of all, if there's a no, I would think there will be a bigger sell down. But if it's a yes, it will be status quo, because in my opinion, the market has already priced in the fact that they were going to undergo this restructuring. So yeah, so that's my view. And regarding the first part, was the manager's answers to the questions satisfactory? Yeah. I understand why they did so. So yes, the answers to the questions generally, was satisfactory for me. Yeah, and then there's another one on Prime. Any updates on Prime and Manulife follow-up? Yeah, so Prime, they also do not have any updates since its release, and going into 2024, the outlook for office will probably be not as bad as this year, as this year was really disastrous as interest rates rose. There were no transactions in the market and such. So, and next year, the return to office trend also is starting as more employers mandate employees to go back to office. So all this will help to kind of lift the US office sector as yes, we think probably as bottom or will be bottoming out soon. So yeah, we maintain our of course year-end valuations, we are still keeping a look on that, but overall we are still holding a buy recommendation unchanged for Prime US REIT. Yeah, we also expect a valuations decline for further valuations decline for Manulife and Prime US REIT and Keppel Pacific as well. Yeah. The next question is, what's the outlook for REIT going to 2024? Yeah, so for REITs, we are now overweight. First of all, because we think interest rates, we are towards the tail end of the hiking cycle, of maybe the rates have already peaked. So going forward, the rates can only come down, and that will be beneficial for REITs. And so that's one point. Another point is that the price to NAV now is trading about 0.8 times compared to the historical about 1 time, slightly over 1.03 times. So this basically means that it's the REITs are trading at a discount to their valuations, to their book value. So we think it's a good play. And the forward dividend yield, because of the sharp share price correction also, the forward dividend yield is also now trading at above the 10-year. I can't recall the numbers, but it's trading above the 10-year historical averages as well. And the fact that the 10-year Singapore government bond yield has fallen also from a couple of months, 2 months ago, it was at 3.5, now it's around 3. So the fact that it's fallen, so the yield spread is also increased. So basically you are being compensated more for investing in REITs now. So outlook going to 2024, we are positive on REITs. Please comment on the profit guidance on capital and investments. Will this apply to other property developments? Yeah, so basically for the profit guidance for capital and investments, they came out and said that the valuations for their overseas assets, especially China, UK, US, Australia, will be hit. And as a result, they will have their net profit will be hit. But all this is basically non-cash items, or rather it does not affect the operating performance of capital investments. And will this apply to other REITs as well? Yes, we expect further, because of cap rate expansion, right? We expect the valuations of all these overseas assets, especially with cap rate expansion. Singapore valuations are expected to hold stable because cap rates didn't really move in Singapore. But for overseas assets, we expect perhaps 50 to 100 basis point expansion in cap rates, and as a result, the valuations will be affected and decline. But for the profit guidance for capital investment, most of it is the fact that they'll have some losses in fair value losses in these property valuations. But the operations remain okay. Mass issues started due to revaluation of their portfolio. This happened to REITs exposed to China. Yeah, so for REITs exposed to China, their gearing levels, they are not so high as to hit or rather breach the 50%. So yeah, even if the valuations decline, I don't think they are very high risk of breaching this 50% or MAS gearing limits. So yeah, I don't think it will happen to the REITs exposed to China. Hi, then your price target for capital and invest and prime REIT still holds in view of latest financial guidance. Yeah, it still holds. Basically, we have a 1-year outlook. So yeah, we try not to be so affected by near term or rather I wouldn't call it noise, but near term unfavorable news, because we have a longer term outlook for our target prices. So yeah, we of course, unless the like the fundamentals has changed significantly and will affect in the longer term. Otherwise, if it's in the near term or some negative news in the short term only, yeah, we don't really we won't really change our view because we have a longer term outlook. But yeah, basically for the valuations, we already kind of anticipated the fact that there'll be some valuation decline for capital and investments. Yeah, we already mentioned it in our report as well. So yeah, we've already accounted for all these. Yeah, I think I'll just handle the rest of my colleagues for now. I'll come back again. Yeah, thanks.
Okay, I take over. Thanks, Darren. The first question for me, Peggy, you seems positive on BRC. So what about peripheral related counters to this industry? For example, Pan United, Cromwell Asia. By the way, you mentioned new negative. What can you elaborate this? Thank you. Okay. Yes, BRC. We are positive because we were very excited by the fact that they have been able to push up their volume so strongly in the second half till end September, despite the challenges still faced by the construction sector. So similarly, for this same reason, we also have a buy on Pan United. And comparatively, Pan United does not face a decline in ASP like BRC, so they should do even better for second half of 2023. For BRC, another reason why we are positive also, which I did not mention there, is that they generated very strong ROE and returns on invested capital. So the market is always discussing about their gearing, high gearing, which is also they have reduced that. So even with the current gearing of 0.4 or 0.5 times, the net debt to EBITDA is just down to 1.3 times. So the EBITDA generation is very strong for BRC. For Cromwell Asia, a very big component comes from the sale of the engine at China Yuchai. So it's not they own 20% stake in BRC. So similarly, the contribution from the local construction sector should do well. But the China side is a something I didn't do a lot of work in, because the sales in the past few quarters have been lifted by the changes in the emission standards that the truck owners have to meet. So I'm not sure after any change in this emission guidance, how the sales will perform. So I cannot comment on Hong Kong Asia in an intelligent way. Yeah. So, sorry about that. We've put a nil for negative because we don't see any negative from this latest set of results. This comment on nil negative is just based on our analysis of the results that has just been released. Yeah. Thanks. Next question is, Peggy, what is the reason for the large drop of revenue from supply chain for FUYU from first half to 22 to first half 23? And this first supply chain, when they first started, they went into sourcing plastic resin. They said they think they have volumes, the scale of volume here, because FUYU themselves also use a lot of plastic resin. So they probably have an advantage in terms of getting a good price and then trade in this commodity. Then along the way, they also do other products as well. So it's not a fixed type of products that they do, a type of products. So another reason for the decline in first half 23 I could think of is that because they most of the products that they do are relating to what they are already using. So in the tech sector, the output has been falling. So the demand for all these raw materials might also have fallen off must also have declined. And things to note is they incur a small loss for trading activities in first half of 23. So drags down their first half earnings as well. Yeah, thank you. I don't cover banks. Glenn is on leave, so but I'll try this one. Please comment on our bank's exposure to Chinese properties in percentage terms. Now, I briefly scanned through the bank's latest third quarter results. For UOB, they mentioned that Greater China real estate sector accounts for 1.3% of their total loans. For OCBC, is 1.2%, so relatively small. DBS does not give a separate disclosure for Greater China real estate, but DBS loans exposure to Greater China, excluding Hong Kong, as at end of June was 12.5%, and not is for all types of loans, and in our understanding of DBS, after listening to the call, most of their loans in China are really extending to the Singapore companies or the MNCs that are operating out of China, like our CapitaLand and so on. And they are backed by good collaterals. In terms of NPL, if you look through the breakdown, China and Hong Kong loans NPL is actually one of the lowest at about 1% of total loans, compared to like in ASEAN, the NPL ratio is about 2.3%. And just recall the last two sets of results. Our local banks face some write-downs. I mean OC and UOB, some write-downs are mainly relating to the exposure to Thailand. So in terms of Chinese exposure to China market, they're actually quite well. They actually been doing very well. So I think the market has over discounted the exposure to China, and especially to Chinese properties. That's just the number is very small. Okay. Next question for me. Anything wrong fundamentally with Sembcorp with the recent softening of price? We don't see any issue with Sembcorp. The reason for the price decline is also across the board. Globally, we also see a decline in the value of companies and assets, that owns assets in renewable, offshore, and wind business. So Sembcorp has a big exposure, and lately have been investing into China for renewables. So the association with China and renewables seems to create that negative sentiment. But the one thing to highlight is that Sembcorp's renewable projects in China or even in India are onshore and they're not offshore. The difference is that onshore is cheaper to construct, cheaper to operate. Although the maybe you could not get more subsidies, higher subsidies from government, maybe but still you're still selling to the grid, and the operating metrics is more more certain, and so we don't see anything wrong with the Sembcorp's fundamentals at this point. Thank you. Okay, let me try this. What is shadow banking? Is it good for operators to involve in this trade? Shadow banking is broadly a term used for anyone who extend lending or even private credit. You can even also call it shadow banking. When maybe they have excess cash or they see a margin opportunity they borrow cheap, they can lend out at a higher value, a higher rate. So is it good for operators to involve in this trade? It depends on their balance sheet, really, and depends on how they manage their risk in this space. So it's not necessarily a good or a bad thing in our view. You really have to look at it case by case. I'll try this one. Any idea what's happening to our three banks? Hit quite badly again today. Okay, JP Morgan came up with another short note to highlight their cautiousness on the banks, that they think that the risk is rising for asset quality. Probably the banks would need higher provisions to be made. But they also qualified that the banks are trading at very low valuation on a historical basis. So just a brief glance of the bank's third quarter results. We think that they have provided adequately. They have actually upped their provisions for the three banks, and for them they have ample gross general provisions made. This overlay allows them to, if they need a higher need to provide for higher for greater risk, they can actually use the overlay from the general provisions. So we think the banks have also guided that the credit provisions will normalize in 2024. And for the banks, so for the three banks, the loans growth continue to decline in this year. Mainly because the rates are down, the margins is not attractive for them. The competition has come in very significantly from the Malaysian banks. Actually, you look at the Malaysian banks, the quarter results, RHB, even Maybank, the Singapore books actually expanded by 7%. RHB, CMB, or expanded by 10%. So they have been very aggressive in extending in the loans in the local market. So if you want to borrow, maybe you can talk to the Malaysian banks, because they are the ones that are pushing down the lending rates. So there's a heightened competition is keen here. So the banks, but in terms of asset quality, we think the banks are adequately covered, and they are very careful in managing the risk in this time round. So therefore, we don't see any asset quality deterioration. And this JP Morgan also mentioned that all these recent outages might mean that the DBS might not be able to pay out the special dividend that the market is expecting. We think there's a bit of a stretch here, mainly because I think the dividend payout, it really depends on, especially for DBS, they are able to do it because of the very high ROE that they have achieved, because of the way they are able to build their wealth management business and also the fee income. So I think if you take a very balanced view, the outages should not have such a direct impact on the dividend payout on a standalone, on an individual basis. You should look at the banks as a whole. So therefore, I think we'll stick to our overweight call on the banks. Thank you. I think that's probably all for me. I'll hand back to the rest of the team. Thank you.
Yeah, thanks, Bagheera. Some sorry. Please comment on CPF UL capital exposure in China. I'll leave the paper to Peggy, but for CPF, they have about 15% of their assets in China. UL, they have about 6% in China. So developers revalue their properties and hence affect valuation. Yeah, so for their for CDL and capital, they do not revalue, but for UL, they do revalue. Yeah, so I hope that answers the question. There is another similar question that's asking for the exposure for the percentage of portfolio exposure for China, particularly UL. Yeah, CTF is about 15% in China, UL is about 6%. Yeah. Yeah, would you say it's generally less risky now to invest in Singapore pure play REITs rather than REITs with global assets? Yeah, so for this question, right, generally if you invest in pure play Singapore REITs, right now you are getting about 5 to 6% dividend yield. While a lot of the other global REITs, like the overseas REITs especially, I look at the US REITs and the European REITs, they are trading at a much higher dividends and much steeper discounts to NAV, probably because the market is pricing the fact that they have a lot of I mean not a lot, they'll have some asset devaluations or rather decline in property valuations on their end, which is why they're trading below the NAV. So yeah, so it's more of a risk reward trade-off. If you are more of a stable lower risk or more of a risk averse, I would suggest you invest in these corporate Singapore REITs because they are, first of all, they are not so volatile and you are getting that 6% dividends as compared to a lot of the overseas REITs. We've seen the share price swing widely, like the US office is the best example for that. So yeah, if you're a higher risk investor, then maybe you can consider because investing in the overseas REITs because they are trading at steep discounts valuation, but at the same time, we are being compensated for it with a much higher dividend yield of over 10%. Yeah, so perhaps some pure play Singapore REITs can look at this maybe FCT, which is all retail suburban malls, and Far East Hospitality Trust, which have all their assets in Singapore as well. Yeah, so these two are just some examples. They're paying above 5% dividend yield. Yeah, I hope that answers the question on the kind of the comparison. Please share your preference for REITs, hospitality, industrial, office, retail. Yeah, so personally, I still like hospitality the most because first of all, the return to, of course, the recovery in travel to pre-pandemic levels probably by next year. So this will book well for the hospitality subsector as well, and they are also the only subsector that we, in our opinion, their operating performance, like the improvement in RevPAR, will trickle down into the revenue improvements for these REITs, and this improvement in revenue we think can more than offset any increases in operational costs and higher interest expense. So we think this is the only subsector that can generate or give you growing DPU for the next year. So we lost steady. We also like retail because for Singapore, especially since the international visitor arrivals is not yet pre-pandemic level, so there's still room for growth for tenant sales, and as a result, the outlook and negotiations with the tenants for higher rents, it's all favorable for retail space as well. Even though the GST might hurt, the increase in GST next year might hurt the retail sales, but we still think the positive rental reversions potential going forward. For industrial, we think the logistics space is still doing strong, but it will definitely slow down from the pandemic e-commerce growth. So it generally the industrial space and also the weaker perhaps slowdown in manufacturing and the uncertainties in the global macroeconomic numbers as well. All these uncertainties might slow down the industrial space and manufacturing. So and furthermore, industrial were also the outperformance this year for the REITs in share price performance. So yeah, they are trading at a lower yields compared to the other REITs as well. And for office, Singapore office, because of the influx of almost 1.6 million square foot from the IOS Central Boulevard and the Keppel South Central. So there's a lot of supply coming in. So yeah, we are not so basically we say hospitality we are first, and then followed by retail and industrial, and then office. Yep. What is a retail investor component for Manulife compared to Insti holders? Yeah, so excluding the sponsor stake, the retail investor component for Manulife is about 66% retail and 33% institutional investors. Yeah, I think that's all for me. I'll hand over to Miano to talk about the Suntec. Thanks.
Thank you, Darren. I'll take the last part of the outlook question. Yeah, since we don't cover Star Health, but outlook for Suntec rate in 2024 is generally positive. Like due to the limited supply, retail rental reversion probably will still be high single digit, and office will be mid single digit. Suntec convention is also expected to have the full contribution in 2024. And one thing differentiates Suntec is they have very low fixed portion of the debt, around 58%. And we believe it will benefit the most from the expected interest rate cut in 2024. Yeah, that's all for me. I'll probably hand over to Paul or Ambrish. Thank you.
Yeah, I'll just take on one or two, then I think we'll pass it to Zain. Can you share some insights on ComfortDelGro? I think for ComfortDelGro, the latest news was that they raised the taxi fare surcharge and they extended it. They raised the surcharge, the fact down by 10%, the fee. This will benefit the taxi drivers, not so much for Comfort directly, but I don't think Comfort would raise the taxi fares without looking at the data. There must be probably quite the unfulfilled rates is probably rising, and they see the demand to be strong. Otherwise, they won't raise these rates because they know there's competition out there. I think what is happening right now is there's a constraint in the number of drivers, and the high COE is also constraining the economics of those riders. If you want to rent a car, the car's so expensive, then it's going to hurt new entrants into this business or acquiring more vehicles. So I think supply is constrained in a way, but although it's hard to measure because they don't give us the unfulfilled rates. So I think that's why the market I think is the share price recovering after this news. It's just a sign that the demand supply situation is quite good for taxi and ride hailing. Huge sell down on 17 Life. Any explanation and insights? Yeah. So just a bit of background. So huge 17 Life was used to be the VTech spec, and after the D-spec, they have changed their name to 17 Life, and the share price dropped like 40%. But okay, anyway, one of the reasons is we just worry that 17 Life is something similar to what happened to Grab. If you recall, when Grab did the D-spec of Altimeter, they made their valuations was about 40 billion. The last round of valuation for Grab was only 10 billion. That's like the last round. So some investors probably got it at 5 billion, 2 billion. The reason why I say this is because this is probably something happening similar to 17 Life. Although they value this about maybe $5, my guess is some of the early investors probably got this at $2, $1. So apart from the valuations, you're going to get a lot of shareholders with very cheap shares. And not to mention, the second thing is that if 17 Life was growing very strongly, then you can kind of shield the stock. I mean, you can say that it continues to grow strongly, but revenue has been declining the last 2 years. So I think it also, people view this as a bit of X growth, a bit matured industry. So that's why we ask investors to redeem at $5. Okay, I think I'll pass it to you, Zane, first. Okay, let me answer this last one. Will history repeat itself if Trump wins election in a super bull market? Yeah. Possible in a sense, because Trump always measures the effectiveness or the success of his presidency with the stock market. If you recall, when he was running, he always tweeted about whenever the share price, whenever the stock market hits new highs or so forth. So it might be the same thing. He might best announce, and he doesn't worry about debt. So he could put the US government on another super debt cycle, pushing up the economy and also the stock market. Again, this is all speculation, but if I were to, yeah, but you will bias more towards more positive for the stock market. I'll hand it over to you, Zin.
Okay, thanks for I'll share my screen for the TA portion now. Okay, so first up will be on UOB. So currently, I think for UOB is likely to stay a bit of a range for now. So yeah, price has tried to break above this 2740 level, and today we have a pullback today. So I think likely there is still some quite strong resistance at around 2780. The next level of resistance will be around $28. So likely, I think currently from the chart wise, I see a bit of a range trading going on for now for UOB. Then the next one will be on BRC Asia. So for BRC Asia, I think it's still trending. When we look at the long-term trend, it's still kept within this uptrend channel over here. And recently, we have a new high, breaking out the previous high around 170 over there. So yeah, we have a bit of a bullish flag consolidation going on. I think we could see a little bit of a consolidation first, and then we could see a resumption of the uptrend afterwards. Okay, the next one will be on 579 Hong Kong, Beijing Jingneng Clean Energy Company. So for this, I think currently it's trading this downtrend channel over here. And recently we broke below the recent support of about 155, 156. So I think could potentially go a bit lower to test maybe like 147, 148 as the next support if you do respect this trend line over here again. Okay, then as for the other two banks, DBS as well as OCBC. First up, I'll go through DBS first. Okay, DBS is still showing a bit of a weakness for now. Price is still trading within this downtrend channel over here. So there's we could still see maybe price trade lower to test close to about 30.90 to about $31 as the support. Over here we have previously a range breakout resistance we prepared as support. Also, when I look at the longer term trend line, there was also a trend line support over here. So I think for DBS, if the weakness persists, we could still see maybe price test this level over here where we could find a better support for possible rebound for DBS. And as for OCBC, it's also a bit similar with trading in this wedge, descending wedge over here. So and recently this broken support for 1260, 1270 looks like it's acting as a bit of resistance over here. So potentially we could still see price trade lower to test the support of closer to about 1220 around there, where we see where there's this trend support as well as the main uptrend channel it has been trading in since second half of last year. So that will provide a better support, in my view, if price comes down to these levels. Okay, then some US counters. The first one, AVGO, Broadcom. So for Broadcom recently, there has been a pullback and retest of the prior resistance around 915, and we're seeing a bit of a bounce over here. So for now, I'm expecting a bit of a range, a bit of a consolidation going on. We could see some resistance around 955 first, then followed by 980. So I expect some range bound trading for now for Broadcom. Okay, then next up for Amazon will be, Amazon currently, I think it's possibly consolidating in this wedge over here. So after the run up over here and a pullback from this trendline resistance at 148, 149, it looks like price is consolidating from one. So I'll expect a bit of more consolidation going on first, then we see the breakout direction, whether it's upwards or downwards. Okay, then next up will be Alphabet. Okay, Alphabet, I think Google will be, it's also possibly consolidating over here. It's just that it's a bigger wedge. So currently there's a resistance around 138. Yeah, so for now, the immediate support levels are 134 as well as 130, around 131 over here. So I think price could still consolidate in this wedge over here first before it decides to move, take the next direction upwards or downwards. Okay, then back to some Singapore counters. Next up will be Genting Sing. Okay, for Genting, I think there was a run up over here for the past 3 days. We tested the resistance at $1.02. Over here, I think this resistance likely will hold a bit for now. We could see some range consolidation first for the time being, with the immediate support levels at around 96.5 cents to about 98.5 cents level. And then next up, Fraser Logistics and Commercial Trust. Okay, for this counter, I think is trading this uptrend channel over here. Currently, there's still some resistance ongoing around the 112 level, but I think if the price can stay above this, try to break above this resistance, there's still quite a good chance for it to test around 116, the next resistance level, which will be the channel resistance as well as the previous horizontal support breakdown. Okay, then next up for Franken. Okay, Franken, I think yes, hit some resistance perhaps at the 127, 128 level. So this was previous swing high back in August last year. And over here looks like it's the uptrend channel resistance over here for now. So I'm expecting a bit of a pullback perhaps going on for now. Maybe a bit of a range consolidation, but likely the immediate support of about 190, 120 should be able to hold for now, since this was a recent breakout level and there was a retest over here. Okay, then next up, Silver Lake exists. Okay, I think Silver Lake for now not much going on. It's still quite a bit of a range going on, but yeah, we're still seeing higher lows. So for now, immediate support likely to be between 26.5 cents about 27 cents over there, then resistance about 28 cents upwards of to about 29.5 cents. So I think nothing too much. I think still probably just some range consolidation still going on. Okay, hi. Then there's a question on STI. What level does it need to break to have the reversal trend? Okay, I think for STI, Friday it tested this descending wedge resistance over here again around the 3111 level. Today we have a bit of a pullback going on. So I think for STI, in my opinion, it needs to break above and stand. It needs to break above and then continue to stand above this 3112 level for it to do a bit of a reversal. Yeah, because when I look at the weekly chart wise, when I put out the moving averages, the 5 and 10 moving averages, currently, which are these two blue and red lines, price is still held underneath these moving averages as a resistance. So I think for reversal to take place, we still need to see price break above these MAs as well as the trend line on the daily chart to actually see a reversal possible play out. Okay, then some Hong Kong counters. First up, Alibaba. Okay, Alibaba looks like still going lower below this support around $69 to $70. Yeah, so with that, I think if it continues to see some weakness, it could test maybe like $66 next as the next around 66 to 67. Okay, the next one, Ping An Insurance. Currently is testing this downtrend channel support over here, which is around 33. So let's think if it follows this support, there could be some rebound taking place over here. The next one, 939, China Construction Bank. Okay, I think for China Construction Bank, currently looks like there's some weakness going on. There's a breakdown of this broadening wedge, as well as price is currently resisted along this short-term downtrend resistance line. So with that, if the bearish momentum continues, I think we could see maybe price retest the next support zone, which is around 420 to about 425 over here. Okay, there's a question on Meituan. So I do a quick one as well. Yeah, Meituan, I think generally is still showing a lot of weakness after the earnings gap down. It just currently is still sliding down over here. So yeah, for now there's some support around 83.50, but if it doesn't hold, probably it still can go lower than that. The next key horizontal level based on the past data was around 74 to $76. Okay, then next one will be on Capital Corp. Okay, for Capital Corp, I think currently we're seeing a bit of pullback. After price retested this trend line over here. So it was a previous support. After breakdown, it acted as a bit of resistance around the 680s level. So looks like some pullback and consolidation taking place now for Capital Corp. Okay, next one, Sembcorp Industries. I think Sembcorp Industries currently there's some weakness going on. Price was suddenly break above 525, this horizontal resistance, and then there was a breakdown over here start of last week. So currently looks like if price is still resisted by the $5 mark over here, we could see some continuation momentum downwards towards to test the next immediate support around 470 to about 475 about there. Okay, then next up, city developments. Okay, I think nothing too much for now. It's still mostly range trading for a while, so I think possibly that will still continue to yeah, the support around 610 and resistance around 630 for now. Okay, then for UOL, it's a bit similar. So price has been finding support at the swing low of 580s over here. Then there's likely to be some resistance still around $6 to about 610 over here, which was this support breakdown. So I will expect a bit of a range trading ongoing still. Okay, the next one will be on Parkway Life REIT. Okay, Parkway Life, I think it's possibly consolidation in this wedge over here. So currently it's testing this downtrend resistance line around 355, 356, which actually confirmed with the price. This was a previous horizontal support. That price broke down, and then it's coming. There's also resistance over here. So if this resistance holds, I think there could be some pullback to maybe test the immediate support, which is around 344, 345 level for Parkway Life. Okay, then there's a question on Hang Seng Index chart. Okay, for Hang Seng Index, I think currently there's been quite a decline going on. Price didn't manage to hold this trend line support over here around the 16,300 points level. So I think currently price is heading towards the next support, which is possibly around 15,800 to about 900 level. So over here, this is this blue color downtrend channel support. And previously, back in last year, when we saw a huge rally in the Hang Seng Index from November, this was the level the price actually broke up from over here. So I think maybe price could go a bit lower to test this support. Then let's see whether there's some rebound coming from this level. Okay, see if there's other questions. Okay, there's some more Hong Kong counter. So first one, Tencent. Okay, Tencent looks like it was unable to hold this range over here with the breakdown last week. Breaking down this 315 level. So it looks like I think price will hit towards 295, 296, this support level next, which was this horizontal support previously, and then the breakout level here. Okay, then next up will be on 3032 Hang Seng Investment Management Tech Index ETF. Okay, for this, there's been looks like a rising wedge breakdown ongoing. So currently retesting a support level around 355, around 355 about it. So there could be some support coming in if it respects this horizontal level here. Okay, then there's a question on TSM. Okay, I think TSM currently is probably some range trading going on, but I think there's a bias towards the side. good thing is that price is holding above 96 over here. It's a support level which was a prior resistance in the past, and then currently is trying to test the resistance at about 100 again. So this could be like a bullish flat consolidation for now. So that, yeah, if it can break out like 101, then there could be some continued further upside towards 104 to about 106. Okay, next up, there's a question on Ping Tuo. So yeah, for this currently, I think try to see the past levels. Yeah, so based on the weekly, it's currently at some is there some resistance around the 150 level. Then the immediate strong support will be around 135 about there. So for now, looking back at the daily, looks like there could be a bit of a range consolidation first going on after this gap up over here after the earnings release. So in my opinion, there could be some range consolidation first for the time being. Okay, next one, capital REIT. Okay, for capital REIT, I think currently there's some bullish momentum. So it cleared this 86.5 cents level over here. Then it's heading towards the resistance zone of 89 cents to 90 cents. So I think when price hits this level, there could be some resistance again, which is this there were some old resistance level here. Then maybe we see some pullback consolidation ahead. Okay, the next one is on Citra. Okay, Citra looks like there's after a long downtrend, there has been a breakout of this downtrend resistance line over here. So and then looks like there's also bullish divergence going on. So when price made a lower low, the indicators had a higher low. So there's some bullish momentum coming in. I think price could do a bit of a consolidation first, and then try to form a higher low. I think the support could be around 0.104, 0.105. But yeah, then there could be a reversal going on. Okay, for Apple DC, I think currently is trading this uptrend channel, so it's still respecting that. Some resistance currently around $2. So this is the previous horizontal support over here. So $2 about 204. So here this will likely be the immediate resistance levels. So for Capital DC, I think price could still trade to test these levels. Then there could be some consolidation at the resistance. The next one is Hong Kong Exchange and Clearing. Okay, there has been a breakdown over here recently of the 277 support level. So currently it's around 241. Testing this support level here. So currently 237 or 244. There's this is the immediate support level. Yeah, so let's see whether there's some possible rebound coming from this level. Okay. Next up is on iFast. Okay, iFast, I think there could be a slowdown in terms of momentum. So there's a bearish divergence signal coming in. So a higher high on the price, but low high on indicators, and MACD is some bearish momentum coming in. Then looks like price trading outside of this immediate trend line support of 817. But I would expect price to expect this 795 horizontal level for now. So maybe a bit of a consolidation first for iFast. Okay, the next question on Aztec Global. Okay, Aztec, I think some weakness for now. Price is trading outside of this main trend channel over here, and possibly in this descending wedge over here. So currently you could see price trade to try to hit the support level of about 86 cents for perhaps this swing low, as well as this trend line support as well. The next question is on Keppel Infrastructure Trust. Okay, so I think currently price is undergoing a bit of a consolidation over here. But I think for now that we still hold in bit of range as some near-term systems of this around the 48.5 cents level with this trend line resistance over here. So unless there's a breakout, then we could see some further upside towards 50 cents. But for now, I think maybe some consolidation ahead first. Next question, what indicators do I use to guess that the bottom is already done? Okay, usually I use the momentum indicators like your RSI to see whether like it's in the oversold region, and then I like to use MACD and RSI to see whether there's a bullish divergence near the support. So that would be a strong hint that even though the price broke down, there's a hidden bullish momentum coming to do a reversal, as the last bit of selling could be done to guess the bottom is around there. Yeah. So I think that's all for my questions. I'll pass back time to my colleagues if there are any more to answer. Thanks.
Yeah. Okay. Thanks. Thanks, Ian. Let me just answer one or two, then we can try and it. For some of the banks, the US banks, we don't have coverage yet. But I think we should be having coverage soon. For the US banks. So sorry, we can't answer it yet. What's the status of Hong Kong Land? What are your views on recovery for this stock? Is it a buy or hold? I think Hong Kong Land looks interesting because it's trading at 80% discount to book. And there's so much negative pessimism about it. So always I think it's an interesting contrarian buy. Just that it's been hurt because the valuations are the property valuations of Hong Kong office has come down. The vacancy rate in Hong Kong is quite high actually. It's almost 9%. No, Singapore is hardly anything, maybe 1% or 2%. So they're having quite a precarious situation. But I think if you do want to enter, the best time is probably after the results. You probably need to wait for one more round of not only just for Hong Kong Land. I think most of the REITs probably going to get knocked one more time by their year-end valuations, especially the overseas ones, especially those that have Chinese assets, because you got this the RMB is going to another drag on the valuations. So I think once that is done, then you probably most of the overhang might be over. Pre-pandemic, Hong Kong land also traded at a discount, maybe 50%, 60% discount. So now it's stretched to 80%. So if you're a huge contrarian person, then maybe this looks interesting. I mean, Hong Kong land. Yep. So I think any year-end target, yeah. So we don't do STI year-end target mainly because one of the reasons because STI wants to charge us, the FTSE STI charges money if we want to use their terms. Amazing, nobody's really interested in Singapore stocks, but they want to charge us for using STI. So we actually refrain from talking about STI as much as we can because the others are going to charge us for licensing. There's one question on Airbnb. I think Ambrish is not around, but we will try and get back to you and post it on or Ambrish. Yeah.
Yeah, Paul. So there was one question on Airbnb. Let me just read out. What is the latest on Airbnb? Does it still have a buy rating, and what is it current fair value? So based on the latest for Airbnb, so last month the company announced that it had acquired an AI company, a startup company, which was GamePlanner.ai. And company has not mentioned anything apart from this. So from the we believe that the acquisition was for about $200 million, and the main purpose for acquisition was that it plans to boost its AI offerings. So like the one of the advantage that it is looking at from the acquisition was that it looks to enhance their customer experiences, and by matching the users what they are looking for with the right rooms and the available rooms. So basically matching and providing the better customer experiences. And in terms of so overall for Airbnb, we have a buy recommendation and a target price of 157, mainly because the booking volumes, they have been continuously increasing, and the revenues has been increasing by about 15 to 20% range. And the company, it has also been focusing on higher operating leverage. And last year it reported a maiden net profit, and we believe that in 2023 also it should report a net profit of about $2 billion. And we believe that it's well positioned to benefit from a shift to alternative accommodations, and it's more group and travel friendly. And lastly, also the number of supplies, the active listings on the Airbnb's platform, it has been consistently increasing. And right now, I think it's about 7 million listings on its platform. So that's all for Airbnb. Would like to pass it on back to Paul.
Okay, thanks, Ambrish. So I think with that, I think we would like to end it. Some like Yanlop, we don't really cover, so very hard. We don't have enough details to give probably an insightful reply. So we'll skip that. With that, I'd like to thank everyone for I think you answered most of the questions. I'd like to thank everyone, especially those who thanks everyone. Wish everyone a good Merry Christmas and a very fabulous year ahead, and a Happy New Year to everyone. If you don't, this is our last. We'll catch up with everyone on the 8th of January. Thanks for all your participation and support throughout the year, especially for all your questions. And if you have any further questions, or just send it through our community, and we will try to answer through the P3. With that, I'd like to thank everyone and wish everyone a wonderful 2024 and Merry Christmas. Thanks, everyone.